Everyone is obsessed with the next big theme. Which sector is breaking out next week? What is the budget going to do? What about the election? But if you look at the data, and I mean really look at the history of wealth creation in India, the biggest fortunes were not made by predicting events. They were made by being bored. Pankaj Tibrewal, CIO at Ikigai, broke down the anatomy of a 100-bagger, a stock that can turn 1 lakh into 1 crore. The recipe is shockingly simple, but incredibly hard to execute. Today, I'm going to walk you through the DNA of these companies, so you can stop gambling and start investing. First, let's look at the math. A 100-bagger isn't a stock that jumps 100% in a month. That is a bubble. A 100-bagger is a company that grows its profits by 20% every single year for 25 years. In year 1, 20% looks boring. Your friend buying crypto looks smarter than you. But if that growth sustains, the math goes parabolic. Companies like Pidilite, Shree Cement or Titan, they didn't have one big event. They just kept compounding. Smart money doesn't look for a hot story. They look for sustainability in earnings. So how do you spot them early? Tibrewal points to a concept called small fish in a big pond. To grow for 25 years, a company leads a long runway. They need to start small in a market that is massive. Look at Bajaj Finance. In 2008, they had just 0.1% of India's credit market. They were microscopic. Today, despite being a giant, they still only have about 2.3%. The mistake retail investors make is buying companies that have already saturated their market. The smart money looks for companies where the ceiling is miles away. Now, the next concept is a technical part, but it is one of the most important concepts. It's called ROCE, return on capital employed. Think of it like this. If a company takes 100 rupees on capital and earns rupees 20 on it, that's a 20% return. But the magic of a 100-bagger is that they can take that 20 rupees profit, put it back into the business and earn 20% on that too, again and again. If a company is growing fast but burning cash to do it, that growth is toxic. It destroys value eventually. You want companies with high ROCE who reinvest earnings back into the business. But here is why most people never get the 100-bagger. Even if they buy the right stock, they can't handle the pain. Look at Nvidia. It is a 4,700-bagger. But to get that return, you had to hold it while it fell 75% twice. Look at Amazon. It dropped 90% in the dot-com crash. If you panicked and sold during those drops, you missed the fortune. The stock market doesn't reward your IQ. It rewards your stomach. It rewards your ability to suffer through volatility without selling. So here is the summary. Find a business with honest management. Make sure they're a small player in a growing industry. Check if they earn high ROCs and then do the hardest thing in the world. Do nothing. If you want to read the full data on this, please check out Pankaj's tweet.